Welcome, everyone. Uh, we are so excited that you're here. This is the 16th hour, excuse me, the 16th Growth Hour webinar from Shed Advisor, and this one is about the long view, personal wealth, business value, and life after exit. My name is Rebecca Bradley Ray, and I will be your moderator for today. So if you have any comments or questions throughout the webinar, please feel free to enter them into the chat box and we will answer those at our Q&A section at the end of the webinar. So for those of you at the end of, or for those of you who are on the phone, you can unmute and ask directly after we get to the Q&A section. So just wait for that point. And again, yeah, we would love to hear any of your questions, comments in the chat. So let me introduce our host for today. Steve Byler is a certified speaker and a coach with Maxwell Leadership and a certified EOS implementer who assists leaders and leadership teams in getting clear with their vision in order to get more out of what they really want from their business. Welcome, Steve.
Thanks, Rebecca. Always great to be with you folks. And you just mentioned John Maxwell, and I'm delighted to be here at the International Maxwell Conference right now. Unfortunately, I had to walk out of John Maxwell's talk to get here on time. So that's a shame, but I got most of it, I think. He was running overtime, so I use that as a little justification. So we're here and delighted to value you today, bring value that hopefully you can use in your business and in your personal life. It's a special honor to me to have Kyle Glenn with us as our guest today. Kyle is a certified financial planner, and he's an owner at Glenn Financial, where he brings families and businesses clarity and confidence in their financial decisions. I've known Kyle since he was, well, let's just say quite young. And now as a mature professional, it's been a special delight kind of reconnecting, getting to know him as an adult and a professional. He focuses on simplifying complex topics, helping people take meaningful action. And he has a real passion for kind of the mom and pop businesses, Main Street businesses, hometown businesses. He believes that great financial planning isn't about products or predictions. It's about stewardship, about trust, about making wise decisions that supports the life you're building. And I would just note, the financial planning world is filled with all kinds of compliance concerns. Kyle is here speaking on behalf of Kyle Glenn himself personally. We're not offering any financial advice here today, but we do want to give you some framework, some principles to help you think well about your life, about life as an entrepreneur. And, all of us are going to exit our businesses. And statistics say only a very, very few of us are going to do that well. So, Kyle, welcome today. How can we do that well?
Well, thank you so much for having me, Steve. I'm sorry that I pulled you away from John Maxwell to come talk with me.
I'm not going to blame you for that. I scheduled it, so I'll take full responsibility.
Oh man, what a great question. How to do that well. I think it all begins with the personal planning. I think many business owners will focus heavily on their business as a key focal point. All of their time and attention is put onto that. But it's really the personal financial planning that can hinder a successful exit on the back end. Um, so I'm looking forward to kind of diving into that today.
Sounds good. I have just noted that while this is, for anybody who's on the call, most certainly, we're really focused on business owners, business founders, because founders have a unique challenge in many ways in the kind of level of emotional attachment and the way in which they're embedded in a business and family businesses specifically. So we've talked about, and Kyle, you and I had this conversation, that founders find themselves frequently in a bit of a trap. And we call it the founder's trap, where the business itself, the business they have birthed, the business they have built, the business they're running, is actually the entirety of their financial plan.
Mm-hmm.
And it's another way of having all your eggs in the same basket. And we're here to try to dissuade you from taking that plan. I think I'll just be candid about that. That's not a good business plan. It's not a wise personal financial plan. It's not a great strategy to have all your eggs in one basket. And as the founder, you have agency on those decisions. You actually have options, and you can take yourself out of the founder's trap. And we got a little camera problem here, I think.
Is my camera off?
Uh, I think it might have been a sharing issue. So,
Okay.
and if you could just confirm in chat that we've got Kyle back on in a camera, I'd appreciate that. We want to be sure everybody can see his handsome face. I say
Great.
that for your wife's sake, not for yours.
Yeah, not for mine.
Yeah, well, we want to affirm her choices. This founder's trap. If you're a business founder, there are actually things that you can do. Don't be a victim here. So most people don't take those. And we talked about this statistic. 80% of business owners approach the time when they want to exit their business. They have thought of their business as kind of their nest egg, their retirement plan, their single retirement plan. I'm going to sell my business and I'll live happily ever after. But our friend Dick Halteman, I think you quoted the Exit Planning Institute as well. 80% of people who come to retirement age, notice they don't have the energy to run their business anymore, so they want to exit the business. They want to sell the business. They're not able to sell the business because they don't actually have a business. They have a job, and you can't sell jobs.
Right.
So, what do you see in your work in exit planning, Kyle?
Well, I see, oftentimes there's a heavy concentration of the business as a portion of a business owner's net worth. Um, and that's not uncommon. Typically, for a successful business owner, their business is their fastest growing asset.
Right.
So it's kind of like a runaway train in some ways of you're not going to catch up with it from a percentage standpoint, which is fine. Um, but many business owners will see the success of their business as a litmus test almost of whether or not they need to do the personal planning. Because there's only so much bandwidth that most people have. For business owners, that's all going to the business, into their family. And everything else is going to get dealt with on a different day. And it can leave them vulnerable. I'll just put it that way. It will leave them vulnerable if we bypass that personal planning, as in who are we outside of the business, as well as that personal financial planning, because there was a study that came out from the Journal of Retirement Planning that showed that business owners themselves are less likely to have retirement assets than their employees, and they are less prepared for retirement from a financial standpoint than their employees, because they are banking on the sale of their business as their retirement check, so to speak. And
Right.
it creates a host of issues that you might not find out about it until you get to the exit table, right? Like you might have decades of doing very well, and then when you're about to sign that contract, there might be some issues that show up.
Yeah, and this is a little sidebar. We didn't talk about this, and I'm wondering probably dangerously close to the advice side here.
Oh
But
no.
but isn't there also so much tax benefit in merging your personal planning with your business plan that a lot of entrepreneurs actually miss because they're only building a business, not focused on personally building wealth, resources for retirement when they're for the leaner years outside of business, inside their personal portfolios.
Yeah, exactly. Many business owners take taxes almost as a cost of doing business.
Right.
I think, I talked to a business owner last week where he's about to write a $300,000 check to the IRS.
Yeah.
And congratulations, you made money. So
Yeah.
you make money, you got to pay your taxes on it. Um, but oftentimes the tax planning side is not addressed because of um, how do I say it? The presupposition, I suppose, that just taxes are a cost of doing business. There's nothing that we can do about it.
Yeah. Two
Um,
certainties, death and taxes, right?
exactly. And there are so many things that a business owner, from a personal planning side, could restructure to help keep taxes off their tax return. Um, and part of it, I mean, part of it's an argument of reinvesting into the business because
Correct.
if it's part of a sound strategy, that is, because that business sale at one point is going to have preferable tax treatment versus the ordinary income tax that we'll face on a annual basis of capital gains rate and is this goodwill? Is this personal assets? How does this all get broken down? But I would say that many business owners don't think in that regard. They see their tax bill, and when they meet with their accountant in the fourth quarter, hopefully, and what do I
Really?
need to buy? What do I
Really?
need to
Yeah. Oh,
buy?
yeah. Yeah. That
Before the
conversation.
end of the year.
Yeah. Schedule
Um,
179 stuff.
yeah, and if you're growing your business, there's a benefit there, but then just to buy a truck that you don't necessarily need to grow your business, there comes a point where you need to have another conversation there.
Yeah. So just spinning off of that, one of the principles we talked about, we would like to make really, really clear here today is that for a successful exit to occur, and let me just pause there. Everybody is going to exit their business. Right? Just let that settle in. There's a day coming where you will not be in your business, and you'll either both go down together, or your business will thrive after you're, in the box of the ground. Your business will go on as part of your legacy, or it'll die with you. But we're all going to exit the business someday. And again, 80% of people who want to intentionally exit the business while they're alive don't get the privilege of doing so because they haven't planned well enough.
Mhm.
So, number one, what has to be done to build a thriving business that thrives without you so it doesn't go down into the box with you? Okay, so I think as we discussed this earlier, Kyle, that this should be one of the top priorities for entrepreneurs when they're even early stage of business. How can I, as efficiently as possible, begin to build a business that thrives without me?
Yeah,
Is that a good litmus test?
I think so. Yeah, and it really does come down. I take it into, four intangible capitals that a business owner really needs to focus on in the business side itself in order to have a thriving. What is the human capital, the social capital, the customer capital, and the structure around it all to help have that successful, thriving internal business? And what we'll see, I mean, is that many business owners will be a very good technician of their role. Let's keep it with sheds. They're very good at building sheds and selling them. They may not be as good at leading a team of 30, 40 people once their business grows to that point. And typically, once a business matures to a level, that owner will drift to a certain role, whether it be a technician or they're over their financials or whatever it is. And they have a really hard time of releasing control. And typically they can be their own bottleneck in some regards. And
Yeah,
so,
and just to be Maxwell-ish here, business owners and founders are the lid of their organization.
right. Yeah. And so having those four intangible capitals in mind of how do I build up my people, my customers, my structures to allow this business to grow without me being involved on the day-to-day basis. It's really hard to do that when you're in the weeds of like the first 5 years of starting your business. But there does come a point where you need to come up for air, so to speak, and begin that litmus test, so to speak, because those areas are going to be what buyers want to see when you go to exit. And the
Okay, so
sooner this, go ahead.
give me those four again.
Yeah, your social capital, what is your goodwill, your reputation in the industry, your people, your human capital, your structural capital, what is your chain of command as well as business structure, all of that, and your oh man, I'm going to blank all of a
Customer.
sudden.
So I
Customers,
think
yes, thank you for
customers.
helping me out.
Yeah,
Yeah,
I think I had that one. I was missing one of the others. Yeah,
good. Help
so
me
they
out.
really run parallel to some of the categories. I tend to frame it in terms of, do you have a team? In other words, it's not a one-man show. This team actually carries weight, and they actually have second component. They have clear roles, and there's accountability for executing on those roles. Third, you have a repeatable, proven system, and you have a healthy culture. So there's I think similarities across that. But I like it. Those are intangibles that you can't just create those at the push of a button. You
Hmm.
can't pay somebody to come in and do those for you. There are things you have to build into it to transition from really, what I call a job to a business. A job that's just with you at the center, the kind of the hub of the spokes and the wheel, to really an entire organization. So the people, kind of what is your reputation, your social capital, your name recognition, your brand?
Yep.
Customers, do you have loyal customers that give you five-star raving fan reviews? And then do you have a structure that you only have a piece of the structure? You can leave that piece of structure yourself. Somebody knows exactly what it is you're filling. They can step in and take that.
Hmm.
So that means you have a healthy organization that has been built intentionally, and it's one you can probably exit successfully.
That's right. Yeah. The key man dependency that many businesses have, that structural side or even the human side, where they are their business. That's typically when we say that only 20% of businesses transact based off of that exit planning research study. It's because the majority of Main Street business owners are their business. They have a
Right,
they have a high paying job that they've built for themselves.
right, right,
And it may not be the goal of the business owner to build a team or,
right.
have the exit you want to have from your business, but you need to plan differently if there's no sale on the back end
Right.
that's going to help fill that wealth gap for you.
Yeah, so I had a client, we were doing their quarterly planning in an EOS session, and in setting our expectations for the day together, the he wasn't the founder, he bought the business. But when I asked him what his expectations for the day of planning are, he said, I want a clear pathway to be able to take a 2-week vacation and not have any business interaction.
Mm.
Okay, so that's kind of a form of litmus test. What's the level of chaos when you get back, right? Have I planned? Does this entity actually run as an organization? Is it healthy? Is it running smart? And maybe the better one, 2 weeks is a great start. Can I be gone for 3 months? Can I be
Mm.
gone for 6 months? And the business actually carries on and is successful and it's thriving in my absence. Is that a pretty good litmus test that I actually have a business now that can go to market?
I think so. Yeah, I mean, if the business can survive without you, I think on the flip side of that, it's a litmus test of whether or not you can survive without the business.
Then that's the
You
personal
know,
planning side, right? That's the
yes.
emotional side. So yeah, thanks
Yeah.
for taking us there.
What will be on your business card after you're no longer an owner of your
Yeah,
business?
yeah,
Who are you outside of your business? If you're on vacation and you're checking your email 15 times a day, it's a good indication that you probably have some personal planning to do to not have that emotional tie to the business as much.
correct. And when you introduce yourself to new people, if one of your first kind of identity markers is your business,
Right. Yeah.
again, another test, how much of who I am is my business? Because that does lead to the kind of emotional trauma post sale
Yeah.
that I've seen people go through.
Yeah. So many business owners will regret the sale of their business because they don't know what they're retiring or exiting to. And then they'll boomerang back into some other type of business because now they're bored or they're driving their wife crazy and they need to
Yeah,
get out of the house.
exactly.
See that
Exactly.
very often.
Yeah, and that's again personal planning, building a life outside of the business is an extremely, extremely critical part of a healthy exit plan. And I just have a personal friend who told me over the weekend. He said, 5 years ago, he said I was a business owner that had a family, and through various crises, he said now I'm a family man who runs a business.
Mm.
And I think those are big questions we have to face. If you are something other than your business, that can continue once the business is gone. And I'm curious, in your work, Kyle, as an exit planner, now helping business owners, leaders be intentional about their exit, how do you approach and address some of those concerns?
Yeah, I mean, it's a softer conversation. It's not surrounding numbers, so to speak. And so it does take some more internal work for the business owner that, I mean, they have to do the work themselves, but um, a lot of that is having conversations with, for how the way that I facilitate it is having conversations with the business owner and typically their spouse and just allowing the spouse to speak because the spouse is typically the one that may not be as involved with the business and they are I don't want to make any generalizations, but they're more aware of what's going on in the family and the goals and the dreams and the hopes of the family. So I just have the spouse speak and give them the license to say whatever they want to say. And if they get into a fight, it's my fault, right? It's,
Yeah,
you have
yeah,
someone to blame. It's almost like a therapy session in some ways. And allow the spouse to say, we've always dreamt about going on the mission field, or we've always thought about moving closer to the grandbabies, and you've always thought about doing this. And because business owners are always chronically busy, it's even hard for me to turn off business. I think about it all the time. And so I allow my wife to be the one to remind me of who I am outside of the business because that's who she sees the most of. And I find that to be one, really a fruitful conversation because it allows the spouses to connect in a way where, like, reminding them of who they are outside of the business
yeah.
and what they want to do, and allowing them to come together as a team and not just like self-manufacture, oh, I think I need to do this because this is what typical retirees do. But no, this is what my spouse, my family see in me, and this is who I actually want to be. And those conversations tend to go really well. They they can end in tears at times, which is great. But
Yeah.
I see that often. I feel like in my capacity, I am more biased towards the number side of things. And that's what I do every day.
Right.
But really it's that personal planning that is the most impactful. And I can't manufacture that as a professional. I need them to generate that themselves.
Yeah.
Uh,
It's fair to say it's something that's discovered because
yes,
it's
absolutely.
actually present.
And it's not just one conversation.
Oh,
It's oftentimes, hey, I'm seeing this on the financial side, but you've been saying this. How do we get these to reconcile with one another? For example, I just worked with a business owner that wanted to do a internal transition of their business. And he wanted to basically sell the business to his sons, which for many people, that's a legacy plan for them of wanting to continue their business. But he had thoughts and hopes and dreams personally that didn't align with how the business was going to transact. Because with an internal sale, it typically comes with a lower contract value.
Right.
You're probably not making your son pay top dollar for the business. It's just as a rule of thumb.
There are exceptions.
There are exceptions, yeah.
I'll note where, yeah, they pay a premium, but that's so dad can retire. But
Exactly.
let's,
And so like having knowledge of what's going on in the business as well as what's going on the personal side allows those conversations to naturally come out so that when we do get to here's what our measurable action plan is from this exit planning engagement, we have a clear understanding of what needs to happen on the personal side as well as the financial and business side so that everything works in conjunction and one thing doesn't get prioritized over the other.
right. I would just note something here that the work I do as an EOS implementer fairly early on working with leadership teams is we try to discover, we call it the core focus. And the piece of the core focus is what is the purpose, cause, or passion that has been driving you as a founder? Why did you start this business? And frequently it's not about the craft or the technology or the thing the business does. There's an underlying passion, or there's a purpose that's fueling this person, this individual, and it has expressed itself in this particular business venture. And when entrepreneurs find that, and I've had two experiences in the last 2 weeks where when we hit the nerve, I mean, here's a high A type, driven, grit, grind it out, all about data. We're going to make things happen. And all of a sudden, there's just this look goes across the face, tears spring out, and they're suddenly dabbing their eyes. You know you've hit the nerve.
Mhm.
And when you find that, that's the piece that got them to the business. It's the piece that's fueling the power of the business. And it can go straight into those leaner years of life where I don't have the energy to drive a business anymore. But that same passion is still present. And a good exit plan can help me find ways to invest that passion without needing to drive financial return from it. So this is the volunteer opportunity, the place where I can now mentor, the place where I can now coach because of this core passion that has been mine. And when a person finds that kind of continuity through their entire life, realize the business is only a part of it, then really their purpose or cause or passion fuels their life all the way to the very end. It's just adjusted a bit along the way based on their limitations, their availability, as to how they contribute from that purpose, cause, or passion. And I think that's really why, again, not just exit planning, but kind of personal life planning, putting a good plan for what my life looks like post business.
Yeah.
Can help with that continuity.
Yeah, and just to tie that together, I suppose, personal planning typically is the reason why the business exit fails, or the lack thereof.
Yeah.
Either because they don't know their why as to like what they will do afterwards, or on the financial side, they haven't prepared well. That is typically when you're going through due diligence during that buy sell period. That's the personal side typically becomes the biggest risk later as you near that exit.
Yeah. And I think it's often overlooked, right?
Yeah.
Overlooked. And it's also why, and this is true now, not just for entrepreneurs, but for people whose jobs have been such a big part of their lives, and they suddenly don't have the job anymore. And that loss of purpose, that's why so many retirees die soon after they retire. They have no more purpose. They can only sit at home and annoy their spouse for so long until they, take up a hobby or just give up, throw in the towel. And it's really tragic because there's so much wisdom that ought to be offered at that slower season of life.
Mhm.
And again, good planning helps those to actually be powerful transition seasons rather than, and it's, a personal mentor, counselor of mine would just say it's a shift from a productivity mindset, how much can I get done, to an effectiveness mindset that says, what do I have that can have an impact?
Right.
And retired people, post-business exit entrepreneurs can have massive impacts.
Well,
Well,
they have all the wisdom, right?
yeah, yeah. And you need to prepare for that moment.
Yeah. Yeah. And it's, like what do you want your legacy to be? Many business owners, their exit from their business is forced upon them in some regard. Journal of Retirement Planning came out with that study. Like a vast majority, that decision to exit their business is forced upon them rather than a proactive decision. And
Yeah,
the
yeah.
mental shift that I try to have business owners that are like looking at this is instead of getting to the point where you're overreacting and you're stressed out because of what's going on in the business and now you want out, how do we be proactive and think about how do I want to exit this business from my choice and then be able to give back to that next generation of leaders after I'm done to continue my internal purpose that I have.
So excellent note there, Kyle. And I've talked to business founders getting ready to start a business. And I said, this is the time to be thinking about how you plan to exit.
Yep.
Build the business for the exit, not because the goal is the exit, but a business capable of an exit gives you tons of opportunities and options.
That's right.
So it's not like our exit planning only occurs once our backs are against the wall. We've had 3 bad years in a row, and I just don't have the energy to fight this one more time. That's when most people want to sell. Okay. And they're going to go out at their absolute lowest valuation if they can
Yeah.
go out at all. Might
Yeah.
just be a fire sale. And
Yeah.
and that's why exit planning is not something you wait to begin until your goal is to exit in the next 5 years.
Yeah. Get it done start as soon as possible.
Start as soon as
Yeah.
possible
That's
so
a,
that you have a plan to run your business, a plan that gives you the maximum options all along the pathway of being an entrepreneur.
yeah.
So let's just talk a little bit about, and you gave kind of the 4 categories, the four what you call intangibles around business. But let's talk a bit about business readiness and just get kind of down in the weeds a little bit further, maybe, and the
Sure.
business readiness and the personal readiness.
Yeah.
And I think maybe you mentioned something around a scorecard. Is that around readiness or is that something different?
Yeah. We've created for exit planning clients a personal readiness scorecard, which I'd be happy to share at the end of this. It mainly just shows how ready are you from a scale of 1 to 100. Are you to step away from the business itself? And that's one of the first things that we do is go through a personal readiness and a business readiness so that we can identify specific things that need to be addressed as soon as possible before you sell to help de-risk the situation when you go to the exit planning table. The first thing many people want to do, when they go to EOS or with us specifically, is that they want to figure out a way to build value. That's
Yeah.
that's their number one goal. And the first thing that we need to do beyond just the readiness scorecard is identify what is valuable already. There is probably something in the business itself that's already valuable. So we need to first identify and then we need to protect. What that means is we identify the things that are issues within the business and on the personal side that could be risks overall, both to the personal and business side. And we protect that area by addressing those issues. And then we go to the building phase. Not until we have a good foundation of what we have and how we've protected it can we really build value within the business that is manageable and is repeatable. You know, if you build off of a bad foundation, it could all fall apart.
Yeah. Yeah.
And then at the end of that all, we harvest and manage it on the back end. Oftentimes I'll find a business owner that comes to me and they're so tired of the business or they're overwhelmed and they want to, like I had a guy call me last year, hey, I want to sell this thing. It was, November, he wanted it out by the end of the year, right? I'm like, well, that's probably not a good solution for you, but he was so
Here's an
overwhelmed.
auctioneer's phone number.
Yeah, right. He was so overwhelmed. Like he wanted to get to the harvest, right? He wanted that net worth that's been on his paper net worth of his business to be in an investment or a bank account where he could pull some money out and enjoy life. And if you skip over the steps and if you don't do it in order, you're not going to have a successful transition.
Okay, so you've got the three steps here. Identifying what's of value, and then focusing on protecting that. And step two then is building based on kind of the core of the value of the business.
That's right.
Be sure we build there and we're not building from chasing shiny objects.
Right. Exactly.
And only then can we prepare for harvest. So really it has agricultural parallels as well, right?
Absolutely.
We're
Yeah.
picking our seeds, essentially identifying where the value lies. And then we're going out and cultivating and preparing the soil appropriate to the seed we have, planting it, cultivating it, fertilizing it, irrigating it as whatever it needs to get to the harvest.
Yeah. And during that identification step, you identify what type of business you have. Is it one that is saleable? Just
Right.
inherently, is this something that we can build to be saleable, or is this a lifestyle practice or business that has a phenomenal income? Fantastic. It gives you that license of life that you're looking for, but you're not going to get that harvest. And so, as we go through the next few steps of de-risking and protecting and building, those paths look differently depending on the type of business that the person has and their goals for that business. Where a lifestyle business owner is going to have to prepare more like a retiree, like a regular retiree.
Yeah.
Whereas, someone that's building enterprise value would probably eventually want to get an EOS implementer and a team around them to help build that value internally of the business. It's two different paths from that standpoint.
And by lifestyle business, you're talking something tied much more deeply to the founder owner's personality.
Yes, or they might be the only person in the business. There's a lot of businesses today where, like e-commerce, let's throw that out there, where the person can make a lot of money, but if they were to not, do their job, it would no longer make money.
Right.
That key man risk
Yeah.
aspect.
There's nothing there to be sold
Exactly. Yeah.
because I'm not selling my soul. I'm actually wanting to get out. So
Right.
keep player exit what's left.
Right.
And it's also, and we'll look at, what are the acid tests here to help us determine whether or not we have that, or just a couple of tests we can play with. So identifying really, do we have something that can be saleable, can be built? What kind of value is attached to that? And then the other piece, I don't know that we get too far here, but businesses at different stages and at different sizes have different multiples to their value.
Yep.
and the values are calculated in so many different ways in different industries. And I hear businesses say, well, I hear that a business ought to be worth its annual revenue. Well, there are businesses out there that are worth 10 times their annual revenue. There are businesses out there that are worth a very tiny percent of their annual revenue. So those generic numbers are very industry specific, first of all, and then also have very particular qualifiers to every individual business in that industry, whether or not they're actually saleable.
That's right. Yeah. So what I do is we look at the NAIC code of the business itself, the industry specific code, and then pull public data to be able to provide an estimated range of value of
Yeah.
where are you at today and where would a best in class business be? If you were to, do this building and protecting phase, could we move you in that direction and create value on the back end? Um, that's part of our deliverable as we go through that exit plan of figuring out where we are today, where we want to be, and how do we bridge that gap in between
Right.
doing so?
And to be clear here, the space you really work in, Kyle, is you do personal financial planning. You're a certified financial planner so that the individual can use the business as a tool to build personal wealth so that, let's just say, the industry you're in your business fails. And suddenly the industry pivots and it's no longer a thing.
Yep.
I mean, how many people are hauling ice blocks nowadays? Because
Right.
refrigerators just put them out of business. And so unless they pivoted, that business opportunity just died. And if I had not built personal wealth when my business went away, I suddenly had nothing. I didn't even have a job. I lost my job. I lost all the quote wealth infrastructure that I thought I had. All I could do was sell the basic assets of the
Mhm.
business. So we want to mitigate against that risk. That's why we need to be sure that we have a personal financial plan as much as possible in addition to our business. The
Right.
other piece is we want to maximize that business opportunity, both for its health, its maturity. So it's a great business in the hopes that it also has legacy potential. In other words, can have a successful second generation, that it can thrive without me or past me. And that's kind of the second piece where you do, and you call it exit planning. Is that correct?
Yes.
But it's exit planning. The goal is not so much the exit, but have a business that is exit capable.
Correct.
Okay.
Yeah.
And if you own a business that is exit capable, you have now got options. If you own a business that is not exit capable, you have a job.
Right.
Is that an overstatement?
No, that's exactly right. And
Yeah.
and
And I think
knowing which you are as soon as possible is going to save you a lot of heartache.
that allows you then to go into a building phase if you need to go into building
Yeah.
phase. Okay. And that's really the space. You help people in the building phase. The work I do with EOS, we really say is to build value inside organizations. It's to get that team crystal clear. It's to get clear roles and accountability and responsibilities. It's to get repeatable, proven systems. It's to build a healthy culture. And you simply know that as an owner, I sit in this seat. And when I leave, the business continues running and somebody knows what those roles are. They can step in and fill those. The organization can continue to thrive in
Hmm.
my absence because I am not the business. I fill a seat in the business. And
Yep.
again, it allows people sometimes to remain an owner of a great business and step away from any employment opportunities inside that business. They can go pursue another passion and they can own a thriving business. I mean, those are real possibilities. Those are the kinds of options when you have an exit capable business in front of you that you own and operate. So these are really, really critical pieces, I think, for business owners to be aware of. Building a personal life, personal readiness for exit, building a business that can personally be exited, and to do so with great intention and care. So, what are some things you'd like to say to business owners yet Kyle, as we move toward wrap up and some Q&A here?
Yeah, I think one of the biggest arguments I get in with business owners is why would I put money into an asset that returns historically 10% when I can double my money year over year in my business? Mainly, like, why become a personal wealth builder when my business is doing so well? And the reframe that I try to have my clients see is um, if I owned a $30 million business, or if I had a $30 million net worth and $29 million of that was my business, everyone's like, wow, that's amazing. How did you do that? What team did you do? That's amazing. But if I had a $30 million net worth and 29 million of that was in a publicly traded stock, say the company that you're watching this off of, you'd be like, man, that's done really well over the last 40 years, but don't you think that's a little risky having all of your money in that one basket? We do that every single day with our businesses. And there comes a point where the business does not need every single dollar that you have in order to survive. And that idea of pulling chips off the table that can grow for you without having your sweat equity in
Yeah.
the sooner you can do it and allow compounding to work for you, the better. But it gives you that option there at the back end. And yeah, that's oftentimes the biggest argument that I'll have with business owners because they're seeing their printed money in their business, so to speak. Why would I pull any dollars from that? And depending on the stage of the business and the age of the business owner, I may agree with them. Yeah,
Yeah.
throw it back in there. That's amazing. But hey, you're 50 years old. You got 15 years left before you want to retire. Now's the time to start pulling some chips off the table for you.
And there's some great tax benefits to do that as well if you do it carefully.
Yeah,
So and I think they have to look at not merely the ROI of the investment itself, but the overall strategy has to be factored in here. The business can't be the entire plan.
exactly.
Your life has to be the entire plan, and a business has to be a facet of that plan, which means we have to think about the financial implications of that as well.
Yeah.
The business
Get-
can't be your entire financial plan.
Getting the business owner to zoom out
Yeah.
and see everything from like a 30,000 foot view is a hard thing to do. But once they get to that point and they see their business as a portion of their investment portfolio and not in separation or isolation, that's a super powerful point of like, okay, now I see the risks associated with my business. I'm going to start pulling some chips off and then start building towards the life I want to live afterwards.
Yeah. Excellent. Okay, Rebecca, do we have any questions?
Not quite yet. So, anyone, if you have any questions, please go ahead and add some. I do have one, so I'll get us started here. And this, I know you touched on a lot of different things, Kyle. But what is the top thing that you see with business owners that would be helpful for them to start now to prepare for a future exit? Like, say they're at the beginning of their game. What is something that you're just like, this one thing is like the top thing that would help so much down the road with preparing for exit once they get to that point?
That's a great question. It, I hate to say this, but it does depend on the business owner. I think having an end in mind before they even get into the business, how am I going to get out of this business before you even get in is a great framework to have. I think the most recurring pain point and where most business owners can have the most impact is on their taxes. Um, because and the first thing that I do as a planner is to review tax returns because it's an autopsy of what's going on in their lives from a structural standpoint, legally, like are they set up as an LLC or an S corporation? How much profit are they going? How is that growing for them? What I'll find is that many business owners will be improperly structured from a tax perspective. And that can just leave dollars on the table because now they're paying that to the IRS versus keeping it in their business. And you wouldn't think of it this way, but looking at a tax return can really give an insight to the strategy of the business owner. And then, okay, now we can flesh out a variety of different conversations from that. As an example, I had a business owner. I'm just finished an exit plan for him. He has 10 times more cash in the bank than what his current liabilities in his business are. So his current ratio, if we're going to use proper accounting terms, is 10 to 1, which is an opportunity cost. We don't need to have that much cash in the bank. Either reinvest it in your business or pull it out of your business and put it into something more tax efficient because that money sitting in a taxable bank account allocated to a high yield savings account is kicking off a bunch of interest that is now taxed at your highest marginal federal and state tax rates. And oftentimes, I talked to this business owner, he liked the peace of mind of that cash provided. But I asked him, okay, how much did you make off of this? I made $55,000 of interest. It shows that right there on the 1099. What are you talking about, Kyle? I was like, no, 42.75% of that went away to taxes. So you took about half of it home. Light bulb, never thought of that before. Like, what could you do with another $25,000 in your account versus writing that to Uncle Sam? And the planning opportunities just come from there. I think the tax, I don't know if that directly answers your questions, but for me, looking at a tax return can just give clarity as to what needs to be addressed first, and then we chart a path as part of that.
That absolutely answers the question, and I appreciate that. Is I don't mean to kind of interject here. I haven't seen any other questions coming in
Keep them
yet.
coming. That was a good one.
Is systems also a part of that? Like if someone finds themselves being like the be all end all bottleneck business owner, is that something that you also go through with them? Like how to transfer
That's when I bring in a
things?
Steve, like
That
that
makes
does
sense.
quickly get outside of my professional wheelhouse, so to speak. What I do notice that there's about four different types of entrepreneurs. There's the exemplars and the altruists. Exemplars are the top of the line, the Steve Jobs, the Elon Musk. Just by definition, Main Street business owners are not exemplars, or they would not be on Main Street. That's not a knock on them. It's just kind of how it works. The altruists kind of lend towards nonprofits, charitable work. So they kind of weed themselves out from Main Street businesses. The main ones that we see on Main Street are parents where their business is their baby, and they treat it like that, and generals where they have a very high grasp of their business. They are their own bottleneck. General is not a term saying that you lead a lot of people. It's more so that you just like that locus of power that the term general implies. And with both parents and generals, the biggest risk they have is key man risk because they are not willing to create and delegate systems out to other people. And so, a really easy way to see if you're a general, for example, is that if your business income has stagnated in the midst of a growth effort, you are your own lid because you're not releasing that power out. And that's when a system needs to come into place to create something to allow that business owner to start releasing power to other people.
Yeah.
And that's where, an EOS implementer that's your wheelhouse. For
Oh,
me,
you got my juices flowing, Kyle.
for me, it's an educational aspect. I know enough to be dangerous, but I don't know enough to feel comfortable charging for it.
Okay, well, we're
Okay.
getting close to the wrap up, and Kyle, I'm just going to toss out kind of four what I call acid tests.
Yeah.
For are you ready? Are you ready for an exit or not? In other words, are you exit capable? And if you're not exit capable, you've got a job, not a business. You've got work to do. And then I'll let you respond to those four. I think we've
Okay.
discussed these primarily, so it's a kind of a recap.
Okay.
But the first one is, if I had to step away from my business for 6 months, would anything break? Okay, and I know people who have stepped away, had to step away involuntarily. Okay, heart attack, major life crisis, massive burnout, incapable of work. I've got my own story on that front. Okay, that becomes an acid test of whether or not your business is exit capable. If it can't survive that, and I would say even continue to thrive through that
Yeah.
kind of crisis, you're not exit capable. Another one, ask yourself honestly the question, who truly owns the key relationships and decisions in the business? And if all of them come back to you, you're not exit capable. A third one, and this is kind of the personal side, what part of my identity, what level of my identity is tied to my business? Okay, if it's extremely high, the business may survive you, but you may not survive exiting the business.
Right.
Okay, so this is kind of the personal component we talked about earlier, your personal readiness. And then finally, and you might have to ask your employees this question. Am I building a company that other people can lead or one that only I can lead? Okay, and I recently just started working with an EOS company, an incredibly sticky culture, incredible levels of loyalty to the leader of the company, well over 100 employees, but has no senior leadership in place that could step in and take that leadership. Everyone is stuck to him.
Mhm.
Okay, that's not a business that's not exit capable. So anything you want to add to that and just give us your final concluding wisdom here?
I don't know if it's wisdom.
It's got to be, even at this stage of life, you're allowed some.
I'm allowed some. I do have some gray hairs. I think those are great litmus tests. The Yeah, I don't know if I have much to add there. Those are really well thought out, Steve. And the main one that I really focus on a lot is that identity,
Yeah.
that identity tied to the business. Um, and it's the most important aspect, that sense of purpose that you have outside of your business. You've been business owners have been stewarding their business for decades. Who are you now? Um, I, I think that one, if you're going to start anywhere, start there. And then, I love that 6 month break as well. Um, but the sooner you start, the better. I have some business owners that are 10 years out. I have some that are 40 years out,
Yeah.
from a desired exit. And really, the sooner you can start answering these questions and addressing your business with these tests in mind, you're just going to have more options on the back end.
Yeah. Thank you, Kyle. And again, I want to just leave this as a kind of concluding line here. All of you will exit your business. I've heard way too many stories of that exit being a cold, clammy grasp of the hand in an ICU unit as the founder is passing away, sometimes at an untimely, unseemly age, and they hadn't planned for their exit. And in one case, an 18-year-old son standing there, walking out of that room, carrying the weight, of a $25 million company he had no idea how to run.
Right.
Or the spouse suddenly being left with 50 employees looking to them. What are you going to do tomorrow? Because the husband passed at 42 years of age. These real things happen. And the question is pretty simple. What are you doing to be exit capable? And the higher your score on being as exit capable, the better a steward you probably are of your resources that you have in front of you. So thank you so much for joining us here today, Kyle. And this will be up on YouTube here in just a couple of days. We'll be sure your contact information is there as well. Feel free to reach out to Kyle. And what's the best way to reach out to you? I just realized I don't have it on my slide here.
Yeah, best way would probably be by email or LinkedIn, kglenn@glenn-financial.com. If this is not going live for a few more days, I probably will have a YouTube channel up and running by that point. Kyle Glenn CFP. Look me up on YouTube. That'd be fantastic, and you can go from there.
Sounds good. Thank you so much. And ladies and gentlemen, thank you for joining us. We'll get this link out so you can watch it again and extract more wisdom to be sure that your business is exit capable.